Welcome to the next in our Back to Business series of webinars. This one being about essential forecasting and management information for fundraising and growth. I'm David Seaton. I'm Commercial Director of Evoke Management. A few quick bits of housekeeping before we start. If I can ask everybody to keep their microphones on mute, then that would be great. We are recording this session and we'll send a copy to everybody afterwards. And you'll see that if you're not familiar with Zoom, which I doubt that there's anybody on the planet who is unfamiliar with Zoom now, then please use the chat facility to ask any questions as we go along, and we'll break off towards the end for a Q&A session a little bit later. So, for those of you who don't know who we are, then we're a team of highly experienced finance commercial directors, around 25 of us that help SMEs to move forward with their growth, investment, team management, banking relationships, exit, and that sort of thing. Obviously, recently, much of our focus has been on helping businesses get the funding that they need to not only survive, but to thrive as we come out of the COVID period. We're running a series of these Back to Business webinars, and today's is all about getting your forecasts and MI, management information, to work for you and your business. Now, finances can be complicated, and it's easy for entrepreneurs like me to get lost in the detail. Whether it's sample balance sheets, closing balance sheets, baseline forecasts, baseline three-way forecasts, it's all a little bit complicated for us non-finance folk, and there really is no point in receiving a detailed management pack from your accounts department if you don't understand it and work with it. The number of businesses that I've met over the years who will dig through a drawer to get out their most recent business plan or MI, and it's not been open since the day it was ever printed. So I like to compare the finance function of a business with the cockpit of an airplane. And there's an awful lot going on, and you really do hope that somebody knows what all those dials and buttons actually does. But what are the actual most important elements to the passengers? How fast, how high, where are we going? And if there's a big flashing red light, we rather hope that there's somebody up front who'll be able to sort out the problem before the plane crashes. So the numbers are very important, but the way in which they're presented to both management team and potential funders makes an enormous difference. Then, as you can see from the example that's on the screen, you can see at a glance how fast, so how quickly are our sales going, how high, what are our margins like, where are we going, where's our profit going? And these are the key drivers that you need to be able to run your business. And at a glance, any potential funder can see how successful your business is and where it is that it's heading. So during this webinar, then one of my colleagues, then Robert Green, is going to talk to you about how to do this, how to simplify, then what type of information that you need to produce for your own management team, but also if you're trying to raise finance, whether that be through one of the government schemes such as CBILS, or whether it be one of the more usual routes to raise investment. So over to Robert.
Good morning, everybody. So I'm going to whiz through some of these slides of information that you can find elsewhere. And really focus on, in particular, some practical tips and a case study, which I hope you can find interesting. So next slide, please, David. I say the topics I'll cover very quickly. We talk about the current finance availability that you can apply for. And then relate that to the information required specifically for those applications, but will be considered for any application you make at any time in the future. I hope to give you an insight of what's involved in compiling your pack, how best to present it, that's the most important thing, and relating that to an actual case study that involved a COVID bills application for £1 million, and what you should be doing post-COVID. Next slide, please. Okay, here's a list. You'll have seen it several times before, so I won't dwell on it. Please, if you haven't already, go to the British Business Bank website, find out what's available and who it's available from. But basically, there are government-backed loans to apply for that will need to be repaid. It's not free money. And there are also grants that don't need to be repaid, but are simply can be regarded as refunds against expenses that you've already incurred. And just to highlight this week's development, the Future Fund had been opened for those with the startup businesses that won't have a financial performance history. Okay, next slide. Right. These are the basic principles that you need to be eligible for a CBILS loan, but they will apply to every application for finance that you make. I.e., you're going to have to prove that you are a viable business. And because we will have all had the effects of COVID, you will have experienced a dip, whether or not you needed finance to get through that dip. But in the future, you're going to have to explain that dip. And blame it all on COVID, i.e. prove that were it not for the period of inactivity, you were on an upward trend. And the most important consideration to any lender is that you will have the ability to generate enough cash from your business, not just profit, but cash, to fund the repayments for the entire term of the loan. Next slide, please. Right, so what data are the banks, or any lender for that matter, looking for to accompany your application? Obviously, it's the published accounts, those at a company's house. Your profits may have been suppressed for tax reasons. If that's the case, then you should make that clear and try and upscale your trading profitability as much as possible. They're most concerned or interested in your MI, your current MI, your management accounts. That will extend beyond purely just a list of whether you made a profit or loss to include your measurement against your own budget. The other not necessarily all financial indicators of how well your business is, the key performance indicators. That could be your sales, your number of new customers, the customers you've lost, your conversion factors, all those sort of things that don't appear on a profit and loss account. And how to present those, the good old behavior over time graphs. And if that's a term new to you, you're going to see a few shortly. Again, you need to illustrate the effect of COVID that has on your sales and profit. Illustrate being the key word, because a picture paints 1,000 words, so the song goes. They're going to look for the new trendy thing, the three-way forecast. And what that means, it's not just a P&L, it's not even a P&L and a balance sheet, but it's also a cash flow projected for the entire duration of the loan that you're looking to borrow and subsequently repay. For the CBILS and for general bad practice, you need to prove that you've taken advantage of all the other government assistance. That includes the furlough, the rates, the grants, payment deferments, all those sort of things that would be expected to be shown on your cash flow in particular. The most important thing is to get over exactly what the funds will be used for. And what I mean by that, it's not just simply to be used to pay off a current overdraft. No, that's not what they're looking for. They're looking for you to prove that the loan will enable you to have sufficient working capital to grow your business, generate future profits, and most importantly, generate the cash to repay the loans. And you must illustrate, I can't recommend this highly, that you know things about your key customers and your supply chain. Next slide, please. Right, how to increase the chances, well, of success. If you have a business plan, and I hope you have, if you haven't, you must get one, create one. make sure it's well thought through and that it's integrated with ultimately your cash flow forecast, and you've done an assessment of the key risks to your business and what you can do in mitigation. You must be realistic, not optimistic. I think anybody that shows a sales graph with sales starting immediately after COVID at a historic high is living in cloud cuckoo land. And if you're deemed to be too optimistic in those sales projections, it will undermine the lender's confidence in any other things that you've provided. Please be aware of your sector trends. As we know now, different sectors will be affected differently with COVID. Always cite your particular performance against how your sector's doing, and be aware of I'm going to say the government restrictions currently, and take that into account as you predict your recovery. You must identify those costs that you can control, and I'll come back to that. And please, you strive to use summaries, tables and graphics rather than narratives. At the end of the day, anybody receiving an application will be inputting it through in their computer system to satisfy the algorithms that the bank have set, and ultimately have their computer say yes to your application. So it's narrative they'll find hard to input. Facts, figures, numbers, trends, easy to input. Next slide. Right. How optimistic should you be? Refer to your behavior over time graphs for your sales trends. Look again at your sector, how you compare against your sector, your reliance on your key customers. If you're confident that they will recover well, then you can base your projections on that. If you know they're struggling, then please don't be too optimistic on how quickly their order level will resume to pre-COVID measures. Consider the relationship with volume and margin, and this is your sensitivity analysis. You must always include a sensitivity analysis. You may tactically choose to take a reduction in margin in order to attract higher volume as you seek to recover after COVID. So that's fine, you can strategically plan for it, but the bank will want to see what's the effect on profit if you miss a volume target or you undershoot your targeted margin. Again, emphasize the fixed and controllable costs. Those fixed costs you will have as almost as an overhead. Those controllable costs, you need to highlight that you can actually flex those. You can scale them up, scale them down, in line with the actual sales that you're achieving. And as we move into the three-way forecast and consider the cash flow, you should be calculating exactly what your working capital requirement is. And that can be affected by the levels of stock that you hold in your business. That's tying up cash. Do you really need that much stock? Or the alternative is, if you've got too little stock, that you're actually unable to fulfill the requirements of your customers. Look closely and model the payment terms. So that's payment terms, both in terms of how quickly you will get paid for your orders, and how long you can hold out paying your suppliers. It makes a big difference to your working capital, i.e. your bank balance. Next slide. Right, looking at some of the graphics. There you can see we've got a profit forecast. It has a comparison with last year, has a comparison with the forecast, both in terms of numbers, in terms of percentages, in terms of a block graph that shows the sales movement, the movement in overheads, whether it's a decrease, an increase. It shows absolutely to the bank very, very quickly the direction business is moving, right? You may have a business cycle throughout the year, a high season of summer or Christmas or whatever, and the snapshot where you take your balance sheet at the time of the application can be influenced by that. So it's important to show the bank how your profit is made up over a 12-month period, so that they can relate to where you are currently in that cycle. And there's your behavior over time graph on the bottom right hand corner that has 3 years. It has last year, it has this year, and it has your projection for next year. Next graph. Right, there we go. That's an expansion on the slide that David had earlier, with all the 3 main things that drive profit, i.e. sales volumes, the margin, and your overhead costs. And then that bottom left-hand rainbow block, that is your profit sensitivity. Here illustrating that if your planned margin was 71% and you've predicted a 2.3 sales growth, then you're going to make 160 gross profit. But what if that margin tails off? You've had to give a bit more discount and it drops to 68. What if then that will fall to 139,000 in this example? And what if you fall 1.7% short of your sales target? Your gross profit falls to 121. Banks will relate to that particular diagram in that particular format very, very quickly, and it will give them confidence in terms of your projections. Next slide. But know how your sales are made up. I've talked about the trend, the business cycle over the year. Look at your key customers. If in that pie chart you've got one customer or a number of customers that have got more than 25% of your business, then show some history. As you can see, sales trend by customers, because their performance is key to your performance, and give confidence to the lender that you understand your customers. Next slide. Right. So this is the other the 2 of the 3-way forecasts. You were blitzed by David's screen earlier. This is the bits that are often forgotten when people make applications. You've got that balance sheet. You've got the level of stock, your working capital. Sorry, excuse me. And how that's moving. There will be ratios that will be drawn from your balance sheet, that will be your overall borrowing, and your ability to cover the interest on your loans, and make those monthly repayments, all revealed by the cash flow statement, which will show the funds in, the funds going out, and how much cash you hope to retain at the end of each month, and going forward at the end of each year as you project out to years 2, 3, 4, 5. Next. Right, I'd like to share with you a recent experience I had. This was a business, or is a business, in the travel industry. They're particularly described as a DMC, i.e. Destination Management Company, and their business revolves around attracting tourists from Europe and North America to come and visit the UK. And short story, you can go through this detail at your leisure when you get the slides. But basically, they'd been hit by the uncertainty, particularly visitors from Europe, caused by Brexit. The Germans in particular stayed at home, the French to a lesser extent. So their published accounts for their year ending 19 showed that their profit had basically disappeared, and they've got net current liabilities. Because of the cycle of their business, i.e. their profit is made in the summer, their December 19 balance sheet showed them approaching their overdraft limit. And by the time you got to February, you had £500,000 loss, and they hadn't got a balance sheet to present. So you can understand when the CEO decides just off the top of her head that £2.5 million would be a useful cash injection. Government, thank you very much. when she made that application by simply answering 10 online questions, the manager politely declined to accept her application and actually recommended to her that she talk to professional advisors about liquidating her company. Quite a drastic response. Right, what did we do to turn that round? We looked at the cash forecast, including negating any income through their peak period. And what it actually showed was a requirement for £1 million, not 2.5 million. We put together the application with far more concise narrative, not a load of waffle, all of it supported by their current key performance indicators, which was showing the various sectors of their business that were growing. The French business had expanded. The new North American business was doing very well indeed, and they'd got lots of future bookings. Still, the HSBC manager requests a referral to accounting practices on their panel to audit the data. That was going to be an expensive exercise. It was also going to add 2 or 3 weeks to the whole process at a time they were right up against their overdraft limit. And so we were able, using some HSBC contacts, it had to be said, to convince them for us to submit our own independent report on their application. Next slide, please. The things to pull out from this is we're able to illustrate that the business was indeed viable. Their published accounts should have been revised to show them in a far stronger position by revaluing their assets and rescheduling their liabilities. And although their profit was a negative, it was able to demonstrate using KPIs and behaviour over time graphs that they had an upward trend in both sales and profitability, were it not for the effect of COVID. So I had to, in the end, prepare a retrospective budget for 2020. They were flying blind. They had no idea of which direction they were traveling in financially. And so putting all that into place, proving that they had an order book that could come alive with once some travel restrictions were lifted, that they would have the ability to repay the the £1 million over 6 years. Apologies for that. 6 years with the first year free of repayments. And that was demonstrated by a 3-way forecast all the way up to 2025. It incorporated the payment holidays, incorporated all the other government finance and assistance we subsequently helped them obtain. And importantly, going back to the cost that you can control, I was able to provide specific details of savings they could make, significant savings they can make in both their payroll, their office costs, and their IT. That ensued further confidence in the lender of the profit projections. The result of all that hard work was after 4 weeks of the original £1 million application, the HSBC manager who was assigned to deal with that, who had absolutely no knowledge of that company at all, recommended acceptance, and a week later we got the formal offer. So a good outcome, and I'd just like to finish by sharing with you some of those graphs we used. Next slide. So there we have it. We have a knowledge of how our sales are made up and what the trend is then in each market. Over on the top right is that behaviour over time graph showing the upward trend of sales, the upward trend of EBITDA, a phrase that hopefully you're all familiar with, but basically it's your profit before interest on the loans and before depreciation. And you can see there with the dotted line is what would have happened had it not been COVID, and that familiar that V, which will become very familiar in all businesses, is the effects of COVID. Bottom left, my good old favourite, the sensitivity analysis related specifically to this company. And bottom right, an illustration of the controllable costs. This is their FTE. These are their staffing levels, both in the past, both now with furlough, and going forward. And you can see with those monthly payroll costs, how much they're currently saving thanks to the 80% subsidy and how much they will save subsequently coming out of COVID. Next slide. Right, planning for the COVID period. Measure your KPIs. Know your key customer sales patterns, your achieved margin, know your sales stock levels, and know your days outstanding sales, your days outstanding payments, i.e. the length of time you take to pay your suppliers and your customers pay you. Maintain a detailed cash flow for 90 days. Make sure you've got the loan repayments properly covered and any payment holidays that you've got, including HMRC, and don't, as one of my clients did a week ago, completely forget that they owed VAT of £70,000. It didn't appear on their cash forecast. It's ultimately going to be repaid next summer, but they'd completely forgotten about it. And I always recommend having a rolling 12-month freeway forecast. So, last slide. What should you be asking yourself as your business owners, right? If you've got a business plan, how relevant is it? What are the key factors in your business that you should be measuring? And what is the trend? Is it positive or is it adverse? Does your current budget, and I suspect it's only for 12 months, include balance sheets and cash flows? If not, you need to get them. Do you know what your predicted bank balance is in 3 months' time? It is the most important figure. And do you have an updated 3-year forecast showing profits, working capital and cash? If you don't, you know where to come to. Thank you very much.
Thank you very much, Robert. Very good. Rob, my colleague Rob, do we have any questions that we can run through very quickly, please?
Yeah, there's a couple of questions that came up. One around, I just pick up one that's just come up. So 90-day detailed cash flow, is it by month or by week? Robert, do you want to just answer?
The model I use is it's literally by day for the next 2 weeks. It's there then by month, by week for the next month, and then the last month of the last 6 weeks is a monthly total. It's best that you can do it by day because you constantly refresh your forecast with what actually has happened in your bank, and you can reconcile it to that daily bank balance.
Great. And just one other question, well, 2 other questions that came up. So one just around people find it complicated which route to go down in terms of different types of funding and how to utilize the options with VAT and deferred payment. So I've also shared a link for people to help get help with that, which is a funding requirements checklist. So people can take a look at that, fill in their details, and that's something that we can help with because it's a case-by-case info. The other thing that's just come up around these graphs, how we create those, and yeah, how that's produced, that's something we can help with and advise with, and that's something that we can talk to you about as well. David, do you want to just wrap up from there?
Sure, thanks, Rob. So there are different ways in which we can help. The simplest way is through a free 30-minute consultation. And if you follow the link that was on your screen a moment or 2 ago, then it will take you to a form. If you fill that in with as much detail as you would like to share, then we'll be in touch for a free call with one of our finance directors. Going forwards, then there are 3 current levels of service which we offer to our clients. The first 2 are very much around current government funded schemes. Level 1 being for those people who have most of the information to hand and just want to have a check before they actually send it to their banks. Level 2 for people who perhaps have less information to hand and really need us to prepare and to deal with the bank on their behalf. And level 3 is our more standard sort of pre-COVID, post-COVID service of part-time finance directors, part-time commercial directors to really help you to thrive as we go into what is undoubtedly going to be a bounce back period after the end of lockdown. So please do fill in the form. And finally, then my email address is on the screen. If anybody would like to email me directly with any questions, then please do. And last of all, as I mentioned earlier, this is part of our Back to Business series. We do hold webinars every Friday, and on your screen in a moment will be an invitation to next Friday's, where the title is Raising Finance, What You Do and Don't Show the Bank. So no more ado, thank you very much for listening to us, and we look forward to receiving your forms and to seeing you next Friday at the next Back to Business webinar. Thank you very much, everybody.